All right, class, welcome to part 2 of our discussion of chapter 11. And some kind of oddball. We've seen how things work in the form Schedule D and so forth. Now, let's look at some things that outside the ordinary, you might say. So, worthless securities. This is when a company goes bankrupt or something in a situation where you own stock in them and you can't sell it. So you can't do the normal thing of, this is what you paid for it and this is what you sold it for and figuring out the gain or loss in this case, because you can't sell it because a company becomes delisted, it becomes worthless, and you can't sell it. So this situation is treated, there's rules. We don't want to have someone get hurt too bad by this or not be able to take the loss because they can't sell it. So we pay for stock is declared worthless. You would hate to think, change that to 2018, and we sold the stock for $0 on December 31st, 2018. That's how you should report it. That's what a worthless security is you basically can't sell it. It's not worth anything. So you'd have a long-term capital loss on your return. Of course, you could only use 3,000 of that, but you have 5,000 you can carry over the other two. Special section, remember there was a section 1202 stock that we talked about last chapter. This is section 1244 stock. This is going to allow us. The other situation was the gain didn't have to all be recognized. This, you can have a loss that's higher than the $3,000 maximum if it fits under this category of section 1244 stock. Okay? So you can have an ordinary loss actually, and you can have a much higher amount. So if it's, as long as it qualifies, paid 120, loss is 108,000. We could get up to 100,000 because he's married filing jointly. The rest of it is a capital loss. Specific, so this doesn't apply to everything. Has to be a very small business. Can't be more than $1 million invested, and it has to be an operating company, no investment company. It has to actually run a business. It can't just own real estate or something like that. Certain situations where you get a gain from the sale of property to a business. So if you own 75% of the stock in the corporation, which means you can control it, and you sell property to the corporation for a gain, even though that was a capital asset to Eddie, it will be depreciable to the corporation, and that means that his gain is going to be ordinary income, not capital gain. Otherwise, we could have people selling their property to their businesses all the time to do that. All right, sale of subdivided property. So if you buy land and then break it into lots, so you buy 6 acres and you divide it up into 15 building lots and sell it to 15 different people who are going to build their houses on them, okay? Is that capital gain property or ordinary income property? Is it inventory? And so obviously that's a hard call. So the tax law has some very specific rules with regard to this. Okay? So this is what you have to have capital gain treatment. Can't be a dealer, can't be a corporation, can't make substantial improvements. Now that's a little bit of a called. What if you put in some sewer and water in streets? That may be too much improvements, and you got to hold them for at least 5 years unless you inherited them. Okay, so in all years, in which the 6th lot is sold until the year that you sell 6 of them. So you can sell 5 lots and you don't have to worry about it. It's the 6th lot that not have to worry about it. You just have capital gain. Only in the situation of the 6th lot would you have, and after that, would you have potentially ordinary income. Okay? And then don't forget your selling expenses. And then even after the 6th lot, there's only the amount of up to 5% of the sales price would have to be recognized ordinary income. So Sandra bought in 2006. She subdivides and sells 3 lots in 2017. So clearly 5 years. Clearly she's not a dealer in land. This is not her normal business. She knows selling expenses. Basis in the lot is $2,500. So she's going to make $7,500 each on them, and her gain is $22,500 and will be a long-term capital gain. She has not reached the magic 6th lot yet. In 2018, though, she sells 4 more. Total now for those 4, $40,000. She has some selling expenses, pays a commission on these, and then the adjusted basis is the same as there were before. So she's going to have a gain of $28,200, and then since the 6th lot was sold, all right, she's going to have ordinary income up to 5% of the $40,000 minus the selling expenses. All right, so it's still not too bad. Still mostly capital gain, and so generally that's the way it's going to be treated with subdivided property like that. Other ways we have capital gains and losses. Non-business bad debts are treated as short-term capital losses. That means if you loan somebody money and you actually have a legitimate loan, it wasn't just a gift, it wasn't just a friend giving some money, but it didn't have to do with your business. It wasn't designed to generate more business for your business. You didn't loan them money to buy your product or something like that. If this was a non-business and then they can't pay you, you have a bad debt. You have a deduction, but it is a short-term capital loss, and you know that that's limited to $3,000 a year, right? So there's a deduction, but it's not a very beneficial deduction, you might say. Okay, Section 1231 property. This is everything that is depreciable in your business. So these are only business property we're going to talk about here for a little bit. Okay? Now, in order to encourage people to buy these assets, grow their business, make their business grow so that they can hire more people, the Section 1231 treats these business assets kind of the best of both worlds. Meaning if there's a gain, there'll be capital gains. We know how that's the best route, right? That is the lowest tax rates. But if there's a loss, okay, we can deduct it as an ordinary loss, which means we're not limited to the $3,000 rule that we learned about. Okay, so it's like the best of both worlds. All right. So if this is a situation where you have several properties, business property, business real machinery, things like that you sold, and these are the various gains and losses, then you add them all up and you have a negative $3,800 of these types of assets, and that would be an ordinary loss. Now, you should realize by now that if that sounds really good, that sounds like a good benefit tax-wise, that it's too good to be true. So there's got to be some rule that prevents us from doing this all the time, and that is true. Okay? Some of it is going to be ordinary income under the depreciation recapture rules, which override the Section 1231 rules. If it doesn't apply, then it's still Section 1231 gain or capital gain. Okay? And what you're looking at is how much depreciation you've taken on the property. Okay? Personal property we'll look at first. So you got a deduction against ordinary income when you depreciated the property. It went against your taxable income, reduced your taxes using the normal tax rates, not the capital gains rates. So that is what we're going to make up for, you might say. This only applies to personal property these days. Real property stopped applying to in 1986. So here's the example. Sold a machine for $24,000. We bought it $60,000. We took $42,000 depreciation. So our current basis, adjusted basis, is $18,000, right? This, originally we paid for it, okay, minus the depreciation. We sold it for 24, so that means it's a gain. All right, because our base is 18, amount we receive is 24 from our rules in previous chapters. Okay. Now, if this is Section 1231 property, so we say, okay, that's a gain. That should be a capital gain, right? Under the 1231 rules, not under the depreciation recapture rules. Okay, that $6,000 is recognized as ordinary income. All right, up to the 42,000. As long as the gain is less than 42,000, you're recapturing that depreciation from earlier years, and it is ordinary income. So much for the special treatment for Section 1231 assets. Okay. Not only that, but if you have a year with a Section 1231 gain, you have to look at previous Section 1231 losses from past years, 5 years, go back, okay, and offset against that. And taxes ordinary income. So example, we have 4,600 of non-recaptured Section 1231 losses. These are losses on 1231 assets in previous years. We generate 14,000 of gain this year, which should be what? Capital gain. But to the amount of 4,600 from those in the past is ordinary income. The other 9,400 would be a capital gain. So two things that make Section 1231 not be that helpful when it comes to lowering your tax rate. Okay, now that was personal property, that was machinery and things like that. Now look at real property. And we have a similar type of scenario. It's not really recapture of depreciation. It is unrecaptured Section 1250 gain. That's what it's referred to. Okay? 1250 gain. And it is equal to the depreciation on the property. Because remember, we depreciate real estate as well. Okay? It doesn't apply to losses. It only applies for gains. And it only applies to individuals. Anything that is not 1250 recaptured becomes a Section 1231 gain and is a capital gain, taxed at the lower rates. Section 1250 gain is taxed at a maximum rate of 25%. Let's look at an example. Anita sells real property for $520, purchased it for $500 several years ago. At the time of sale, she had depreciation. So, our gain is Anita's gain is $65,000. She sold it for $520. Her adjusted basis is $455. All right. The $45,000, the amount of depreciation is unrecaptured 1250 gain and taxed at 25% maximum rate. So it's never taxed at a higher rate than the regular taxes on this individual. But instead of being 0, 15, or 20, it could be 25% if their tax rate is higher than 25%. The other 15,000, the amount over what we originally paid for it, is Section 1231 gain and has a maximum rate of 0, 15, or 20. It's like a regular capital gain. Okay, so if you've got capital gains and losses and some of these 25% gains and so forth, how do you offset them? How do you make them work? Okay, the best way to look at this is just look at an example. Okay, here we have short term, we have a 25% gain list, and we have the regular long-term capital gain losses. So what do you do with that loss? Okay, first you offset against the short term and the long term 25%. So first the 25%, you first offset against 25% long term gain, then against the short term capital gain. All right, that's the order that you would do it so you end up with $400 in the short term, okay, as your net cap gain. So now there is no 15% long-term capital loss, it's a gain. So what do? You take the short term and apply it against the 25% first. All right, reduce that. So now you have a 25% long-term capital gain of $8,900 and a regular long-term capital gain of $8,400, taxed separately. Okay.